So we want to look at IAS19, which is employee benefits. Right, so employee benefits relates to the monies that we pay to our employees for the services that they provide to the organization. Now, employee benefits are divided into two. We have short-term employee benefits and we have long-term employee benefits. So the short-term employee benefits, we are basically saying the employee is receiving the benefits as they provide the service. So basically, if we are paying you a salary at the end of every month, it means you're actually providing the service. Then at the end of the month, we actually pay you your salary. So that's short-term benefits. As you provide the service, we are actually giving you the benefit. So the accounting for this transaction is very simple. As we pay your wages and salaries, we are simply then treating it as an expense through profit and loss in the year or in the period to which it relates. So on a monthly basis, then at the end of the year, we add up all the salaries that we paid you over the year, and then we recognize that as an expense through profit and loss. That's short-term benefits. So short-term benefits are simple and straightforward. The long-term benefits now means the employee receives the benefit many years after providing the service, right? So we are perhaps saying you are 30 years old and your retirement age is, say, 65 years old, right? So from the time that you are 30 to the time you get to 65, that's 35 years. You are providing a service over the next 35 years, but you are then going to receive the benefits when you turn 65. So it means you are providing the benefit, we are providing the service now, but you're going to benefit 35 years later. So the issue here is, how should the employer account for the benefit that comes in 65 years time when the service is being provided now? So that's basically what we want to cover, right? So this is how post-employment benefits work, or the benefits that you get after you've retired, right? So we are saying you are the employee, you are providing the service now, right? Then the employer on your behalf is paying contributions to a pension plan. So let's say you are the one working for company ABC, then company ABC is paying money to Old Mutual, so that when you retire, Old Mutual then gives you a pension. But you are retiring in 35 years' time. So Old Mutual must find something to do with the money in the meantime, so that it will still be there when you reach 65 years. So Old Mutual then takes the money that is put into your pension plan and invests it. And when it invests it, when you reach 35 years, the assumption is they are then going to take the money from the investment back into the pension fund and then pays you when you reach 65. So that's basically how it works. Right. Now, we have two types of pension plans. So it's important that you understand the difference from this point, because the accounting treatment for both of them are different. So we've got what we call a defined contribution plan and a defined benefit plan. So the distinction or the difference between the two is basically on what is defined. Is what is defined the contribution we are making into the plan, or the benefit we are going to be getting at the end of 65 years. Right now, with a defined contribution plan, what is defined is the amount of money that is contributed by the employer on your behalf. So let's say, for argument's sake, the employer is contributing $100 per month on your behalf, going towards your pension when you reach 65 years, right? So the contribution there is fixed. It's $100. The employer is paying $100 on your behalf to Old Mutual every year. Then Old Mutual then takes the money that was contributed on your behalf and invests it. But when it invests it, they don't know how much it is going to earn. Maybe they've purchased the buildings, they are going to get rentals. Rentals are variable. Or they've taken the money, they invested it in the banks, interest is variable. Which means the benefit that then comes to you is also variable. Sometimes the investments give more money, sometimes they give less money. So the benefit that you then get is variable. So you don't know the pension you are going to get when you retire, but you know that the money is sent to Old Mutual and they are investing it the way they feel is best. And then they are going to give you whatever your plan would have earned. So the contribution is fixed, but the benefit changes depending on how your plan would have performed. That's defined contribution plan. Then defined benefit plan, we are saying what is fixed is the amount of money that you are going to get. So we are saying Old Mutual is promising you that when you reach 65 years, we are going to give you $60,000. So what they have fixed is the benefit. Now, the contributions that you make will vary depending on how the pension fund is performing. So if, for example, they've invested in very lucrative investments that are giving them more money than they expected, it means your contributions will then go down because your 60,000 is still the amount you are going to be given when you retire. If they've invested in investments that are not giving too much return, they may ask you to then contribute more, which means the contributions would depend on how the plan is working or how the investments are giving returns. So what is fixed is the amount of money you get when you retire, but the contributions that the employer make to the pension fund are variable. So it's key that you know that what is fixed in a defined contribution plan is the contributions that the employer is making to the pension fund. Then in a defined benefit fund, what is fixed is the benefit, the amount you get when you retire, but then the installments or perhaps the payments or contributions that the employer is making on your behalf are variable. Right? So that's basically the difference between the two. Now, in a defined contribution plan, the contributions are recognized as an expense in the period in which they are payable, right? Which means basically if the employer is contributing $100 per month on your behalf to the pension plan, the $100 is simply recognized as an expense in the period to which it relates. Then any unpaid contributions are a liability. So if your employer has not paid Old Mutual what they are supposed to contribute, then that amount remains a liability just like any owing amount. So contributions paid relating to future periods are basically a prepayment. If your company pays Old Mutual in advance, it's basically a prepayment. Then in the notes to the financial statements, we simply disclose that we have a defined contribution plan for our employees, the total amount of money that we are paying in Yakamira, so that's basically what we disclose. So that's defined contribution plan. So defined contribution plan is straightforward. Now, a defined benefit plan is now different because what we know is the amount that needs to be paid to our pensioners when they reach that age, right? So this is what then Old Mutual does. They are going to estimate the present value of pension obligations to say, all your employees, they are not of the same age, they didn't join the organization at the same time, which means each of them perhaps will get a different amount of a guaranteed pension benefit that they are going to get when they retire at that particular point. So they use very complicated formulas. It's determined by actuaries, right? They say, let's say for argument's sake, we are expecting that all the employees of company B in present value terms will be paid 10 million when they retire at various times. So this then becomes the pension obligation. But they would have taken the contributions that the employer would have made, and they would have invested those contributions in what we call plan assets. So plan assets could be of the money contributed by your employer to Old Mutual. They've bought buildings and they've put tenants there. They've invested some of the money in shares for companies listed on the stock exchange. They've invested part of it in banks. So the plan assets are a combination of all the assets that were bought using the money. So let's say the plan assets, their value is, let's say 9 million. So what this then means is if we are going to pay all of them today, the assets value is 9 million, but the obligation is 10 million, which means this will not be enough, which means this will result in a deficit. This deficit is what we will then need to cover. If the value of the planned assets is 12 million, say, it means the assets are worth more than the obligations at that point in time, which means this 2 million is in excess or a surplus that we may need to then cover, perhaps by saying, let's make less contributions in future since the planned asset actually has more value than the planned obligation. So these figures, the fair value of planned asset and the present value of pension obligation, are determined by actuary. So they look at a number of things: mortality rate, the rate at which people are dying, the ages, future salaries. Are we expecting that the salaries are going to change in future? If they are going to change, how is it going to affect our pension obligation? Has there been any change in time and age? And then the discount reduced, because we have said present value of pension obligations, which means we would have discounted the future obligations into present value terms, right? So that's basically how a defined benefit plan works, all right? Now we want to consider what's called an asset ceiling. So let's say our plan is in surplus. The plan assets is 12 million, and then plan obligation is 10 million. The amount of money we are going to be paying our pensioners in present value terms is 10 million, but the assets which we have invested are worth 12 million, which means we are 2 million in excess. Right now, we have determined that the plan assets amount should be equivalent to the plan obligation, which means we've recognized an asset limited by a ceiling. We are putting a ceiling of saying our plan asset should not exceed 10 million. Right. Then the present value of economic benefits associated with the plan, which is the plan asset basically, results in us then determining whether we should get refunds or reduce the future obligation. To say the excess is 2 million. Should we get a refund for the 2 million, or in the future, instead of contributing $100 per employee, we contribute $80 per employee, so that the extra 20 we were supposed to have paid is then catered for by extra 2 million that the plan assets are over the plan obligation. So the reduction, the 2 million there, is recognized through other comprehensive income. The idea is we can't recognize it in profit because it fluctuates. If we recognize in profit, maybe the following year the plan obligation is now higher, the next year the plan asset is now lower, so we can't recognize it directly through profit and loss. We recognize it through other comprehensive income. That's basically the concept of asset ceiling. A ceiling that we put on the plan asset to say it should not be above the obligation. Otherwise, we are simply wasting money by putting it there. Perhaps we could use it for other things that could actually give us more money, right? So when we are accounting for a defined benefit pension plan, this is how we do it. We have said defined contribution, we simply expense it through profit and loss. Then defined benefit plan, this is how it works, right? So here we have obligation. Obligation means this is the amount we are supposed to pay our employees in pensions in present value terms. The asset is the plan assets, the investments that we have made. So let's say at 1 January, which is the beginning of the year, the obligation was 25 million. Let's just say 1,000 for ease of reference. So we are saying 25,000 is the total amount of money that we must pay our pensioners in present value terms. But our investments are worth 19,000, which means our investments are actually less than our obligation, which means we have a net deficit of 6,000. So that was the position at the beginning of the year. Then during the year, we would be making contributions to the pension fund. The $100 per employee that we were talking about there, those are the contributions. So if we are making contributions, contributions don't do anything to the obligation. The obligation remains the same. It's not affected by contributions. Rather, contributions are adding on to the asset, which means if we are now adding the 2,000 to the 19,000, we are now at 21. That's why it's going to reduce the net deficit. The net deficit was 6,000. The 2,000 in contribution is then going to increase value of our asset and then reduce the net position. Right. So in terms of accounting entries, in case you are asked accounting entries, we are basically crediting bank because we are making a payment, and we are debiting asset because we are actually increasing it by making more contributions. Right. Then the current service cost is determined by actuaries. So what basically they are saying is, so there are changes that might have happened to our plan. Maybe we've added new employees, maybe we've increased salaries or reduced salaries, maybe the tax rates have changed, maybe the value of contributions have been reviewed by the government. It is so they are going to estimate to say, based on the changes that have happened in the market, is there a current service cost that is negative, being a cost, or is actually positive or to our advantage? So this then increases the obligation if it is a cost, which in most cases it is, because we're expecting that salaries are generally increasing. Retirement age, if it is going to be changed, perhaps it is going to be increased, etc. And so basically we are expensing this through profit and loss and also increasing the liability. That's why it's under the obligations column, which means the net position is then affected negatively as well. Then payments means some of our employees have actually retired. They've reached the retirement age and we have actually made payments. But when we are making payments, it means we need to liquidate some of the assets for us to raise the money. That's why it's reducing the assets column. And then it's positive here because it's actually reducing the obligations. It means if we had said total we were going to pay is 25,000, we've already paid 1.5, it means it reduces our obligation by 1.5. That's why it's positive, it's reducing the obligation. It's negative, it's also reducing the asset. The net position becomes 0. Then our assumption now is, since the obligation is in present value terms, I'm sure by now you know what unwinding means. It means if we are taking a future payment and then discounting it to present value, as we then approach the future, we need to then unwind or return the percentage that we had reduced when we calculated the present value. So the interest rate would then be given in your question is the same interest rate we apply for the obligation, it also for the asset. So obligation side is in present value terms. So we need to add things like inflation, opportunity cost, etc. It increases the obligation. That's why this is negative. It's increasing the obligation. We are also then assuming that if we are contributing money to Old Mutual is then investing that money, and that money is then earning interest, which means they're also going to recognize a positive interest on the assets, hence the 950 that is positive there. So the net position then becomes the interest expense from the obligation less the interest received from the asset. If the received interest is higher than the obligation, the net position is positive, and then if it is vice versa, then it becomes negative. Okay, so we are debiting the asset by increasing it by the interest end. Then we are reducing the obligation by 1250. So then you realize that the net position is the 300 that then goes to profit and loss. So at the end of the year, we'll then say, how much did we have as an obligation in the asset at the beginning of the year? How much contributions did we make? What was the current service cost according to actuaries? What payments did we make out? What was the net interest? Then we get the balances at the end of the year, right? So this is the calculation that we do as accountants up to this level. We've determined the value of obligation, the asset, and then the net position. But the actuaries then at Old Mutual would have done their own calculations based on metrics that will not be privy to. And then they are going to then share those figures with us at the end of the year. Right? So according to the actuary is saying, no, the value of your obligation should actually be 27,000. But you have put the value of the obligation at 26,550, which means you've understated the value of your obligation according to the calculations that the actuary would have done. So what it then means is we are remeasuring the obligations by increasing the value by 450 so that it gets to the 27,000 that the actuary is estimated. So the remeasurement goes to other comprehensive income. So this is how we do it. Obligation should increase to 27,000, which means we're going to credit obligation by 450, thus increasing it to 27,000. The asset's value according to the actual is 20,100, but we had calculated and found 2450, which means our asset should be reduced by 350 to 2100. Hence, we have created the asset by 250. The net position is 800 negative, which means we are going to debit other comprehensive income by 800, credit obligation 450, credit asset 350, which are basically these amounts. So this is remeasurement. Remeasurement happens when the figure we have calculated based on these amounts at our offices is different from what the actual would have calculated using other metrics that we are not privy to. Then we do remeasurement through other comprehensive income. Right now, there are certain instances where the actuary also gives us the present value of future economic benefits relating to the plan. If that figure is given, basically the actuary is telling us that there is an asset ceiling, or the examiner is basically communicating that there is an asset ceiling that we need to take off. We'll do an example and then I will illustrate what that actually means. Right, so let's look at a scenario. So Sahara Trading Company operates a defined benefit plan. At 1 January 2018, the present value of the defined benefit obligation was 7 million and the fair value of other plan assets was 7.2 million. Equivalent values at 31 December 2018 were 7.7 million and 8.245 million. So we have been given the opening balances, we've been given the closing balance. So then for the current year, that's what happened. What amounts are recognized in profit or loss and other comprehensive income? So it means we need to do our calculation the same way. So we say here, other comprehensive income. We say profit and loss. This is our net position. And this is our assets. And this is our obligations. Right. So we have 1 January. So at 1 January, we are told that the present value of the defined benefit obligation was 7 million. So let's just say 7,000 there for simplicity's sake. So 7,000 there. And then the assets were 7.2. So 7,200 there. If we just remove the zeros, which means the net position is the asset is higher than the obligation, which means our net position becomes 200 positive. So this is at the beginning of the year. Then we consider how much did we contribute to the pension plan during the year. So contributions, we are told that contributions of 2 million were made to the plan. And we've said contributions increases the assets, but do not affect the obligation because we're adding more money to the asset, which means the net position is 2,000. So our net position there is 2,000. Right. Then we have current service cost. We said the actuary is going to give us an amount of the current service cost after taking into consideration things like the changes in time and the age, changes in employee numbers, changes in salaries, etc. They do their own calculation and then they determine what the current service cost is. So the current service cost is 1.9 million, which means we are going to increase our obligation by 1,900. This does not affect the asset, which means the net position becomes 1,900 negative. So this current service cost then goes to statement of profit and loss. So this is going to increase expenses or reduce profit in the profit and loss. It's not going to affect other comprehensive income. Right. Then we have payments. So payments means there are people that have retired and we need to pay them their pensions. So we are told that 1 million was paid out to retirees. So the 1 million is paid. If it is paid, it means it reduces the obligation because we no longer have an obligation because we've paid them, and the money comes from the plan asset. So we are liquidating some investments and we are using it to pay pensions. So the net effect there becomes 0. Then we'll have interest. Right, so interest, we use the rate that will be given. The applicable interest rate was 4%. So we always charge interest on opening balances. Right, so we consider what was the opening balance. The opening balance for the obligation was 7,000. We simply say 4% of the 7,000. We get 280 there. Right, is interest expense. Then we look at the asset. The asset's value was 7.2. We calculate 4%. Of it, we get 288, which means the net position is the difference between the two, which is 8, which is actually positive, and this goes to statement of profit and loss. So we determine the value there, 8180. Then 8488. Right, so the net effect is the difference between the two. So our net, or simply writing that column, so our net there becomes 308. Right. Then we don't know whether or not there is remeasurement, but we will know once we receive figures from the actuary. Right, then we are told equivalent values at 31 December 2018 were 7.7 million and 8.25. Which means these are the figures that came from the actuary. So we are then going to say at 31 December. At 31 December, the value there was 7,700 according to the actuary. Then the figure was 8,250. Which means the net was actually supposed to be 550. Right. So what it then means is the value according to the actuary is 7700. So this is negative, sorry. This is negative. Right. But our calculation are showing 8180. So the difference between the two is the remeasurement. So 8180 minus 7.7 gives us 480. So we are putting 480 there. Then 8250 minus 88 is 238. The 238 there is negative. Right, so the net of the two is 242. Okay. So the 242 net, we said it goes to other comprehensive income, or measurements go to other comprehensive income. Now, we are told that the present value of future economic benefits relating to the plan is 408. So what it means is there is an asset ceiling, right? And the net position of the asset ceiling is 480, right? So if the net position is 480, we are then basically saying if the net that we've calculated is 550, we want it to go to 480. It means we need to make an adjustment of 70 there so that it goes to 480. That's how we account for the asset ceiling, right? So that then becomes your complete answer from a defined benefit pension fund or pension scheme perspective. So these are basically straightforward calculations. If you are asked a question in your exam, simply reproduce this table. It gives you perspective, the way that you do your calculations. But I think if you are facing challenges with that type of calculation, you basically need to just practice more questions. I'm sure you will be able to get it. So that's all we need to know as far as employee benefits are concerned. So that's it for now. Thank you.